Well, hello, everyone. I am fired up today because I'm here today with Michael Blanc, the CEO of Nighthawk Equity with the michaelblanc.com, and Drew Niffin, who is the president of Nighthawk Equity. And today we're going to talk about the different asset classes of multifamily. And Michael, can you just talk to us a little bit about which ones might be the best to invest in?
Well, so let's talk about some of the different kind of asset classes there are. Like so, class A, there's like class A, B, C, D. Let's talk about those because people are throwing this stuff around. So, class A is like new stuff, luxury new stuff built in the last 5 years, and it tends to be on the luxury, and they've been significantly renovated, like maybe stripped down, gutted, and that stuff. So the pros, of course, of Class A is that you have higher rents, better tenants, hardly any repairs or renovations. So that's very good. The cons is they're very market sensitive, right? So in an up market, everybody more has more can spend more on housing, and they can afford the good stuff, so they move into Class A stuff. So that's pretty cool. Then there's Class B. Class B is typically less than 20 years old and typically in a desirable location. And the pros there is there's no major deferred maintenance, meaning that they don't need new roofs or new parking lots, except for maybe upgrading the units. Maybe the units are original and they look a little tired and not as modern as they should be. Cons, not so many. Really like Class B because in an upmarket, people are going from Class C and they're upgrading into Class B. And in a down market, people go from the Class A and they go into Class B. So really like Class B, which is why we invest a lot in Class B, right? And then there's Class C, which is a more affordable housing. These are typically 30 years old. They have a dated exterior, interior, few if any amenities at all, and they tend to have more deferred maintenance. That means that I got to think about a new roof or a new parking lot, or there's a tired utilities and things of that nature. And the pros are that, again, they're very recession proof, and the rents and the cash flow, not the rents, but the cash flow tend to be higher as well. And then there's Class D. It's kind of like war zones, right? High crime, and these are areas that we tend to stay with. So those are kind of the different classes in the multifamily. And I already answered your other question, which do we like best, which is Class B, B minus, and Class C plus.
Thanks, Michael. Hey, Drew, can you talk to us for a minute? Can you talk about just the difference between stable properties, a stable value add property, or a distressed property? Can you talk kind of about
Sure.
how those work?
Right. So those three different classes, right? There's stable, light value add, and heavy value add. And what we're doing at Nighthawk is we're syndicating deals. And what I tend to say to people is it's hard to syndicate a deal unless there's a problem to solve, right? So we're trying to solve a problem with the property. And by doing that, we can make tenants' lives better, make the community lives better, and make the investors' lives better. But to make to fix a problem, you tend to be on the value add side of things. So the stable properties are ones where everything's great. Things are working, the units are full, rents are optimized, great property manager is managing the asset well. That's phenomenal. I love that. It's very turnkey. It takes very little work, but you tend to have a hard time buying a property and finding ways to add value on those turnkey properties. So they're very nice, but they're sort of like the pot of gold at the end of the rainbow. It's hard to find them, at least in the syndication world, right? So moving down the chain from that, we have light value adds where either the property has physical distress, the building has problems, or it has tenancy distress, right? Tenancy distress is probably a little bit easier to solve because you can get the right tenants in there and fix it up. So I would probably term that a lighter value add. The heavier value adds are where there's a lot of problems, right? And a lot of problems create their own problems in that it's hard to get banks to finance the problems because it's a distressed asset. It's not producing cash on day one because maybe the whole building's empty, right? And so you have a lot of work to do on these deals. It can be where there's the greatest value add, where it's a risk return thing. But the deep value adds are significant distress. Maybe it's 100% empty. Maybe part of the building was on fire. Maybe it's in a difficult geography. And so the sweet spot for us is probably the lighter value adds. The deals where there's some problems. Maybe occupancy is a little bit too low. Maybe the owner is out of town and just doesn't have their eye on the ball on this property any longer. And you can make some tweaks and fix it and really optimize it. Maybe you can improve rents. Maybe you improve units. Maybe the expenses are way too high. Maybe you can implement a utility bill-back system. Those are the light value adds where you can solve that problem. You can put more attention into the deal and create the value for it. So, it's like Goldilocks, right? You have not too hot, not too cold, but just right. That's how I describe it. Michael?
We talked about the property itself, or we talked about the kind of class and the kind of condition it's in. The other one to talk about briefly is just the location, the geography, and answer the question, what is the best property, right? So let's talk about that briefly, if we may. So we're looking for markets that are growing on the one hand and to have a reasonable yield. So in other words, kind of get the return. And so on the one hand, San Francisco or Seattle might be a giant growing market, but the yield is so low, it doesn't make any sense, right? Versus I might go into a market where the yield is very, very high, but it might not grow. So we're looking for the intersection of those things. But having said that, I don't want to go into a market where the yield is high on the one hand. I see this a lot. People go into a market where it actually has a great intersection, but it's a very cyclical market. I don't like that. Like I don't want to have to time the market. We prefer kind of the boring markets and the ones that are fairly stable. So they didn't have a giant run up in the good old days, and they didn't have a giant run down in the bad days. They're kind of more even keel. So we're really looking for all three of those. We're looking for a market that's a rising tide lifts all boat. And I have a reasonable chance at yield. And then we were looking at, and now within those markets, so these are markets that are stable and they're growing, and they have a possible for yield. And within that market, we want to look for those light value add deals. So Brunson, to answer your question, that's kind of the ideal investment, because here's the thing: if I make a mistake, let's say I make a mistake with my on the operations side of things, right? But I'm in a market that's stable and that's growing. Well, even if I kind of screw it up, the market will fix it for me. So it gives you layers of margins for error on top of that.
So one thing I love that both of you said is that basically that we're about solving problems. And so we find a problem that is solvable, that it's going to take some work. A value add is just solving a problem, and we're able to basically find a solution. That's how you get paid in multifamily or other types of businesses as well. Another problem that we solve for a lot of people is a lot of people have money that's on the shelf or in their bank account or in their retirement account. Like, how do I get a decent return on my investment? And so that's really what we do at Nighthawk Equity, is we really help partner up deals with people that have assets that are looking to invest in those deals. And so if you're interested in being a part of that conversation, you can go to nighthawkequity.com and join the Nighthawk Investment Club. And we'll set up a time to chat and get in touch with you just to be able to develop that relationship. So thanks so much for joining us today, and we'll see you on the next episode.